Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to this week's edition of Through the Noise. Today we are releasing our second half investment outlook entitled Walking a Tightrope. Today's podcast is the first in a mini-series which will cover our key thoughts on the outlook. We'll start by discussing the headlines from the report, and next week I'll talk to different members of the CIO office and go into more detail on both the economic front as well as looking at specific asset classes. To discuss the Walking a Tightrope report today, I have with me Audrey, who runs the CIO office asset allocation team and is also responsible for the team's thematic output. We'll cover the headline changes in our asset allocation calls, including the rationale for increasing our allocation to bonds, why we're adding the UK to Asia ex-Japan as equity regions we prefer, and why gold still makes sense in a diversified allocation. So Audrey, let's kick off. Before we get into your views on the market, can you explain who you see is actually walking a tightrope today?
Well, thanks, Steve. Well, those are central banks, of course, right? They are walking a very thin, fine line, trying to control inflation while at the same time avoiding a recession. And in our view, the second half of 2022 is expected to be dominated by three big macro questions. The first is whether US inflation has peaked. The second is whether the Fed will tighten policies to the extent that it pushes the US economy into a recession in the next, say, 6 to 12 months. And the third is whether Chinese policy support will help the economy to rebound and thus diverge from the slowing growth that we are seeing in US and European economies. So on inflation, our view is inflation has likely peaked in first half of the year. However, the pace of deceleration from here is likely to be slow. So what this means is the Fed is likely to err on the side of tighter policies until there are clear signs that inflation is turning sustainably lower. We now expect the Fed to raise rates by another 150 basis points from here to 3.25 by the end of the year, which is above its neutral 2.5% level. So as the Fed policies turns restrictive, this will increase the probability of a US recession over the next 6 to 12 months in our view. But having said that, a recession is still not a foregone conclusion as yet, given how strong the US labor market is. So the Fed will have to walk a very thin, tightrope as it tightens policy to ensure that it does not push the economy into a recession. And then on China, in the meantime, it is on the opposite side of the economic cycle as compared to the US and Europe. So policymakers in China have clearly signaled that they are willing to offer more policy support, leading us to believe that the economy will bottom out gradually from here.
Okay, so what does all this mean for our investors?
I think the big question is also how much of a recession risk has already been priced by the markets. Because if you look at the US S&P 500 index, it has already fallen by more than 20% since its January's peak. And that compares with a median of around 27% peak-to-trough decline seen during recessions since 1950s. There are, of course, significant dispersion in the declines, but history suggests that the deeper the recession, the larger the drawdown will be by risk assets. So against this backdrop, we believe there are three things investors can do today. First, we would add to bond allocation. While one can debate the extent to which equities are pricing in a recession, what is clearer in our view is that bond yields are looking increasingly attractive. So if you look at US government bond yield, they appear to be past the surge phase, which normally occurs in the early parts of the rising yields. And in a scenario where recession is avoided, then bond returns will likely approximate the yield on offer today. However, if a recession does occur, then the returns generated by the yield is likely to be bolstered by capital gains from rising bond prices, i.e. falling yields. So in either scenario, we see the risk reward of bonds having improved relative to equities. Second, we would also add to income assets. Besides bonds, a wide range of income asset classes such as high dividend yielding equities, non-traditional income, now offers good value. The yield on our multi-asset income strategy is now above 6%, the highest since 2022. And we see this as an attractive level given that it is also sourced from a well-diversified range of income assets. And last but not least, we will trim back on some of our equity holdings and be more selective about where we want to take our equity bets on.
Okay, so let's talk about equity markets then. So obviously there's, you're saying trim the allocation to global equities slightly. in terms of geographies, which areas do you prefer looking forward?
So we believe there are two opportunities in today's market. The first is in Asia ex-Japan equities, where we expect it to outperform global equities. And that's mainly driven by policy divergence between the US and China, where we see the Fed tightening growth, trying to tighten policies and trying to slow growth to curb inflation. Whereas in China, policymakers are looking to provide more policy support to the economy. The second opportunity is in the UK equities, where we expect to benefit from its relatively larger weight towards value style and dividend yielding sectors, as well as more attractive valuation compared to Europe as well as US region.
Okay, and you talked earlier about multi-asset investment. So, and obviously the rising bond yields offering a good opportunity for income investors. Are there any other areas that people should consider when looking for yields or income generating?
So we've highlighted multi-asset income strategies earlier. So within multi-asset income strategies itself, we also like high dividend yielding equities. So if we think about high dividend yielding equities, the gap between equity dividends and the US 10-year government bond yields has narrowed in recent months. But that being said, they still offer a premium versus real bond yields or inflation-adjusted bond yields. And if we look at historically, high dividend yielding equities have also outperformed traditional equities during periods of high inflation regime. And in the current regime where we expect inflation to peak soon, but there could still be upside risk to inflation, strategies with real cash flow such as high dividend yielding equities, multi-asset income for that matter, we expect that to be increasingly favored by investors.
Okay, so let's move on. So obviously one of the asset classes we've been overweight since the beginning of the year, and I know we're retaining that, is gold. So it started this year on a strong note, but also weakened markedly since then. So what's the outlook now?
So we've seen gold prices pull back from this year's high of around $2,000 per ounce in March to about $1,850 currently. However, we still continue to like gold and remain overweight on gold, given our view that US dollars will likely peak over the next 6 to 12 months. And historically, gold has also done well in a weaker US dollar environment. Second, there is also an increasing risk of a recession, and gold typically should benefit from safe haven inflows in the event of a sharp slowdown in growth or possibly a recession. And last but not least, central bank diversification remains a structural theme in our mind, and we believe that gold will increasingly make up a larger component of central bank reserves. And as such, gold, in our view, should be an integral part of investors' portfolio.
Okay, you mentioned that one of the factors for gold is that it does well when the dollar weakens. Obviously, the dollar's been anything but weak so far this year. So, does it seem like that momentum for strong dollar is going to continue in the short term? And then, what's the longer term outlook?
The near-term momentum still remains in US dollar favor in our mind, given sticky US inflation data that will have the Fed keeping policy tighter for longer. And there's also the potential risk of sentiment from Ukraine wars or even other geopolitical tensions that will keep a bid on US dollar. However, on the longer term time frame, we do expect US dollar to peak once there are signs that inflation is rolling over, and then that will allow the Fed to turn less hawkish. We also expect other global central banks to play catch up to the US in terms of policy tightening to help avert currency weakness that amplifies domestic inflation. If we look at the US dollar today, it has already priced in pretty aggressive Fed hikes, slower economic growth, as well as considerable safe haven risk demand. But that being said, timing the exact turning point of the reversal is going to be quite difficult. And in our mind, that will be likely driven by the speed of policy conversion between the US and other central banks, China economic stimulus as it exits zero COVID policies, as well as some form of resolution in the Ukraine-Russia war going forward.
Okay, thanks, Audrey, for joining me and sharing your latest thinking. A pleasure, as always, to speak to you. That's all we have time for today, and thank you, listener, for joining us. If you want to read more about our views, then please go to the SC mobile app and click on Latest Market Insights under the Investing tab. I will be back on Monday with Rajat Bhattacharya to dig a little deeper into the economic outlook and challenges being faced by central banks. In the meantime, wishing everybody a very relaxing weekend with friends and family. Take care and stay safe.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.